right, Ram, welcome, man. Good to see you. I feel like we're sitting in the same room, even though we're not, and I haven't seen you in months. How you doing?
Good. I'm doing really well, Jeff. Thank you for having me. This is so much fun. Appreciate
Good.
it.
Yeah. It's a really short time window, but we found this format, this 30-minute format works well. So let's just jump in. Tell everybody a little bit about your background and sort of how you came. You've created your own fund, which, by the way, for disclosure, I should mention to folks that I am an LP in the fund, a very happy LP. But just give a little bit your background and sort of how you got to where you are today and what you're doing today.
No, for sure, Jeff. So thank you for having me, and super grateful, not only just to you, but all your partners. Hans is an investor, Glenn's an investor, Jishan's an investor. So I'm very grateful to the entire GGV family, and just not you specifically, but thank you for the support. It's a very simple story. Listen, I have been investing for 7 years on the buy side. I'm a very unconventional investor in the public markets. I was an engineer and product manager at Qualcomm for years. Got tired in a big tech company because I wasn't having much impact. Went to business school, studied some finance, went to Wall Street for a couple of years, covering internet stocks at Sanford Bernstein, and really kind of realized that it's better to be a mile deep versus an inch wide. And many people become these generalist investors and they don't have a lot of depth in what they actually know. And when you think about the Warren Buffett framework of, listen, you got to be greedy when people are fearful and vice versa, it's really hard to do that unless you know a lot about something. So from the very beginning, I was focused on depth and focus. I spent 2 years in a big tiger fund out in New York called Falcon Edge, but I really got into my own on the buy side. And that's where the first instinct I had, which is, listen, being a public market investor alone is it's a good business model and will sustain you, and it's interesting and exciting. But the real beauty is to find these companies before they get discovered in the public markets.
Right.
So I plunged headlong into the private markets, I'd say 7 years ago, and left Falcon Edge 5 years ago, joined a phenomenal fund called Altimeter, which you know well.
Yeah.
And over the last 5 years of being an Altimeter, I was one of the people who were the leaders of the firm, and I was able to invest in some of the best internet companies around the world and payments companies. And my old boss, shout out to him, Brad Gerstner, was an incredible mentor and friend. And once I believed that I found my own product market fit, I went to him and said, listen, I'd like to spin out a firm via the same principles that Ultimate was based on, but knowing what I know, which is I'm pretty good at doing public and private market investing at scale around the world. And with his blessing, he was just psyched to support me. He was actually my first check in. And with that support, I spun out Octahedron earlier this year. So we do something very simple. Again, investing, I believe, should be simple but not easy. We run concentrated positions in what I call are the world's leading companies that drive the internet economy. And I define that as the front end, which is the marketplaces and e-commerce companies and subscription models, but also the back end, which happens to be payments companies and some parts of software. So again, we typically run 5 to 12 positions long, so very concentrated, very deep. We do 1 to 3 private companies every year, and then we short stuff on the wrong side of change. But again, it seems simple, but it's not really that simple.
Yeah. And tell me a little bit. I know Brad is a leader in the private and public. One of the questions I get a lot on Twitter is, what do you learn from the private markets that you can apply to the public markets and vice versa? Can you talk a little bit about that? Because I personally am a big believer that there's just a ton of insights that you gain from being in both, but I'd love to hear your point of view, given that that's what you're doing full time.
Yeah. So again, this actually only just works when you are concentrated and focused. So if you did it across, let's say 10 different sectors like healthcare and industrials and financials, you just couldn't do it. But if you focus on a portion of tech, which is what we focus, the global internet market, it is an incredibly efficient process, and it's just an unfair competitive advantage in many ways. So generally, when we invest in a public company, we have to understand what's disrupting those same public companies in the private markets. So access to information, access to knowledge, access to just data points, access to anecdotal information, which is typically done in the East Coast firms via a call via an expert network. We get direct feedback from entrepreneurs, CEOs, management teams, venture capitalists, right? So it gives you a real pulse check on what is happening on the ground in the private markets and seeing what are the underlying trends that people in the public markets don't see just as yet.
Yeah.
So that's number one. For private companies, listen, we don't invest in earlier stage companies. You know our style. We look for companies 3 to 4 years before they actually go public. So what we tend to do as Octahedron is, and I've done this historically, is we aspire to be this trusted entity that gives them insights from the public markets. As you know, most of your CEOs are intellectually curious, but they just don't have the time or the team to give them insights from the public market. So I'll give you a case study of Gusto. So I invested in Gusto. I led an investment on behalf of Altimeter, 5 years ago, right, in early 15. As a function of covering Gusto, I also covered Paychecks and Paylocity and Paycom. And every quarter for a long time, I would just come into the Gusto office and present what is happening in the public companies. What is their go-to-market? Who are their key channel partners, et cetera, et cetera, et cetera. And for a private company, that is a huge source of value. And it's the best 1 hour most CEOs spend. So that's how we kind of bridge the public and the private markets. And hopefully in the process, we get smarter, our teams get smarter, and then, it's a win-win for everyone.
I would also argue that I won't name any names, but I see relatively newly public companies on CNBC talking and telling a very different narrative than the one that I know, because I've spent time with the company previously as a private company. And I think when you see these companies in their formative stages, you kind of get to see the sausage being made. And then when they go public, it's sort of like, a lot of times there's a repositioning of the business and sort of a fresh start with a whole new group of investors. But I do think there's some value to having that historical knowledge and understanding of how the business models work. And it applies as you invest in companies that are 2 or 3 years into their journey as a public company. And often that's where the information asymmetry is, right? The public market hasn't really had a chance to digest the business yet. And I would use Square as an example. When, we were an early investor in Square, it went public. You and I have talked about this. I mean, it sat at a $2.9 billion valuation for about 18 months before public investors sort of figured out, like, wait a minute, this is a really interesting company that's doing a lot more than small business POS. And today it's a $70 billion company. Can you just talk a little bit more about how you think about tracking private companies and then how that informs maybe your small cap, tech investing thesis?
I'll tell you that Square is just a classic example. We've talked about it for a long time. And I remember buying the stock at $12 a share. So actually, it had run up 25% from its base of 9, and we felt like doofuses for missing the first 25%.
Yeah.
But in retrospect, who cares, right? Who cares? So I think, listen, so you're totally right. And understanding the way these companies were built, mostly their culture, their insights, their integrity, their aggression, like what is the CEO and the management team made of early on? Because these companies go through hell and back.
Yeah,
right?
So true.
And many death experiences. And if you actually go with them through the journey, either as an investor or as an observer, you just know that when tough times hit you as a public market company, how the management team will react. It is just this unfair advantage that we tend to have, because the reality is that you're right. Most people in the public stock, they look at the numbers based on the market. They put a revenue multiple. Most of them are flippers, frankly. We don't tend to flip stocks at all, generally speaking. And so my sense is that when you see how a company gets built, what you really, I think the advantage of knowing them privately is what they are made of. Forget the numbers. The numbers will eventually come. It's about how does a management team deal with stress? How do they deal with tough conversations with their board? How do they deal when revenues are down 75%, like some companies did in the last couple of quarters? Then how they've come back. Did they cut? Were they aggressive? Did they fold? That tells you a lot. And again, Square is a case study. DoorDash is a case study, right? Of just multiple near-death experiences. I have companies in my portfolio right now that are going through pain, but when I observe how these management teams have really come out of a tough time and what their real ambition is, you will just know that in the public markets, they will find their way eventually.
Yeah, right? They build that resiliency. It's funny. I had a conversation with a CEO in March, and their business they really got kicked in the teeth with COVID. And now it turns out that they rebounded very quickly. But in March, he was panicked, and I said, "Look, if the worst case scenario is our investment thesis is intact and your business is going to be a $5 to $10 billion company, it's just going to take a year longer. Who cares?
Who cares?
Right? Who cares? We're long-term shareholders. You're a long-term shareholder. Focus on the big picture." But that resiliency that you talk about, I think you see that so much with private companies. It's a little harder to see. Can you see it in public companies? Can you feel it if you've just met a company that's public and not when they're private? How do you get that inside baseball and the DNA and the culture?
It's really hard. And the way we get it historically is because we are in many ways Silicon Valley insiders. We talk to other board members. We talk to other ex-colleagues. We talk to to people, who have been around the business for a long time, which frankly, the average fund cannot get access to. The classic case here is, like, everyone knows the story of, for example, Pinduoduo, right? When Pinduoduo came live, it was...
Well, actually, most people in the US don't know. So can you tell that story? Because it's an amazing company that we know well.
Amazing company. Nobody knows this company quite well.
Let's talk about briefly what they do.
Yeah, so it's a social e-commerce company at its core, right? It's basically a differential way of selling e-commerce to people. But remember, Pinduoduo came from nowhere to, $100 billion in GMV in 3 or 4 years.
Right.
And
let's just pause. 0 to 100 billion in 3 or 4 years. I mean, that's insane.
That is insane growth, right? So what happens typically to a public market investor when they see that level of growth in China? The first reaction is, this is a pump and dump fraud.
Right.
Because in the US, generally, we have not seen that level of scale and growth, period. It happens over a longer period of time. But you and me have invested in China for long enough to understand that these insane, rocket ship-like growth actually is true. Yeah. So when Pinduoduo came public, what is so interesting is, again, I've been a short seller for a long time, and I knew that within those circles, it was being pitched as a pump and dump Chinese fraud. And if you observe the company on its surface, it kind of looked very shady the way they went public. They had 3 rounds of, private fundraising capital, and then boom, on July 4th, when everyone was asleep in America, they they literally filed for the IPO and went public 2 weeks later.
Yeah.
If you do not understand the management teams, and we'd followed the management team for a long time, you would never have known the paranoia they lived in because of Alibaba, and you're an Alibaba investor, so you know how aggressive Ali can get historically. If you're not an Alibaba investor like we have, you don't know the circumstances around it.
Which, by the way, I would add one thing for folks to know is Alibaba and Tencent are so dominant in China that if a company actually gets to scale competing with them, they're doing something right. I mean, those guys they're more dominant in China than Apple and Amazon are in the US.
100%, right? Yeah. But when you look at that and you see how the company basically built itself through that resilient period where they were always literally hiding under rocks to scale. Yeah. And when they go public, people were laughing at them. They're like, this is a fraud. This doesn't make any sense. The GMV metric was a little convoluted as well. So they had a few warts, don't get me wrong. But it had to be done because China is a problematic country for large companies to get built under the shadow of these giants. And again, when people talk about BitDance, another company, I've been very fortunate to invest in them. It's the same story. When you follow this company for 3 or 4 years before the public markets, before public market debut, and you kind of see all the stuff being talked about in the press that, hey, TikTok purposefully and willingly sells data of American citizens back to China, the CCP, you just know it's wrong. You just know it's wrong. And so it's these examples of resiliency, company character, company building, the key ingredients that in the public markets, you will never get a chance to understand.
By the way, why do you think, like ByteDance, another good example, went from 0 to, I think, 15 billion of revenue in like 7 years? Why do you think so many US investors ignore what's happening outside the US? I'll give you another good example. A stock that I love is Adyen, ADYEY. And I mention it to people in the US, they're like, what do they do? I'm like, how do you not know what Adyen is? It's like if you own PayPal and you own Square, how do you not know? But like, why have you looked, like, why are so many investors in the US not paying attention to what happens outside the US? One of the things we love to tell people is there's 7.3 billion people in the world. There's only 330 million in the US. If you're missing what the other 90% are doing, you're missing a huge opportunity. Why is that?
It's so funny, Jeff, you said this because, again, part of the reason we bonded and GGV and other bonded is because we had
it's our advantage. But when you talk to other public investors, why don't they not want to get on a plane? Is that the issue?
It's not that at all. I just think it's a structure of the public market industry. In the public markets, you are a sector-focused analyst. You pick every mutual fund in New York or whatever, or in Boston. You are a US internet investor. Right? You're not supposed to look anywhere else. You're supposed to give ideas within that space.
Okay.
And at a portfolio manager level, I think everyone's intelligent and smart. It's just that there is a certain comfort level of investing in the US. You can do good diligence on the ground in the US. It's just the classic issue with efficient markets. Getting on a plane is not a problem, but how do you get to know these companies well? And also, why do you want to stick your neck out? It's literally that one insight, which is if you are fearless and stick your neck out, and just look at the patterns and understand that, listen, when you're ordering food in America, you're also ordering food in Beijing and Mumbai and Berlin.
Right.
It doesn't matter. And again, so for internet companies specifically, they're very global in nature, which is why from the get-go, we decided to be a global firm. I don't think it's laziness or lack of getting on a plane. Most Americans are not well-traveled.
Right.
It's
Yeah,
just
less than 50% of Americans have a passport.
own passport. So I just think it's a comfort level thing.
Might be off, but it's directionally accurate.
It's a comfort level thing. It's a what I call it's not lack of intellectual curiosity. It's a structural thing in the public side of the business.
Yeah. Hey,
same reason why venture firms do not do international investments.
Can we shift gears and maybe talk about your views on the market currently? We've had obviously an insane run up this year. Software stocks are at all-time high multiples. Interest rates are low. There's a whole bunch of things that have driven the market this year. Can you just love to hear your thoughts on where we are, and maybe love to hear your thoughts on what might happen over the next 3 or 4 months. You don't have a crystal ball, but we have an election coming up. We have, potentially increased tax rates. I don't know. Just love to hear how you're thinking about things.
Yeah, I think the markets are expensive by almost every definition, especially in technology. In certain parts of software, it doesn't make any sense to me anymore. It defies all definitions of gravity at this point. That said, in what we cover, again, it's a very simple thing. We're at a point in time where the world is flush with liquidity. People have time to go and trade, both retail and otherwise.
Yep.
And the Fed has basically given us a free pass for 18 months at least. So rates are up and people all want to make a quick buck. We've seen this kind of euphoria happen in 1999. And I would argue that tech is in no place where it was in 1999 because there's a real business being built here. We saw the same thing in energy stocks in 2007. Like, euphorias happen at the tail end of a short-term bull cycle. That said, it's very hard to know what's going to happen, and also very hard to say what's going to stop it, right? Mm-hmm. When rates are as low as they are, and people kind of know that rates are not going to go up, not for 18 months or more, like 3 or 4 years, everyone is in the search for yield. So where do you want to go? The rest of the world is X growth. There's only 2 places of growth in the world. One is technology, one is biotechnology. Biotech's too hard because it's binary in nature. So you go behind stuff you understand. Software, especially, what is interesting, the observation I've had is, I used to be a software analyst 4 years ago, and then we got back into software a few months ago. I got to be real that the metrics that we use to measure software companies, long-term free cash flow margins, NDRs, ARR, it's the same thing in the last 4 years. Nothing's really changed.
Right.
I just believe that people have understood that the cloud is structurally bigger for longer. And it's actually very easy to analyze it. So software companies are very easily analyzable because take the current NDR, you got last year's revenue, have an estimate on current year, how much new revenue you're going to pick up. And that's a revenue estimate.
Yeah, and just to clarify for folks, NDR is net dollar retention, which, by the way, 5 years ago was a metric most companies didn't publish. And then
now they do.
Yeah, and analysts caught on to it that it was a really important metric, and so companies have started to put that out there in their roadshows and follow-ons. But it's a hugely important metric in software, and it's a sign of a super strong company. I can tell you, for me personally, I love owning companies that have high NDR, right? Because you start the year, that $100 is going to look like $120 the next year if you just take the year off. And so the idea that you can just keep compounding on top of a net dollar retention number is just super attractive part of the software business model.
But the reality is everyone knows that now. So the question is, where is the incremental edge?
Yeah.
Right. I think that's why I think software have done so well historically, but it's hard to believe that they will do equally well over a 3 to 4 year period. That said, at the end, where are you going to go for growth in yields? Are you going to bet against technology? We don't plan to. You don't plan to. And so the point is that I think this will go on for longer than people expected. We have to, by design, therefore, we have to look out over so in the past, if we were able to look out into a 1 to 3 year horizon, now we're forced to look out over a 3 to 5 year horizon to make an IRR that's respectable. Right. But the reality is, I was just going through this discussion with an LP this morning before our conversation. But the reality, if you take a 5 year view, I am reasonably confident that in certain parts of tech, in certain parts, not all of tech, we have doubles and triples looking at us in the face. And that's what makes me excited even today. And yes, the markets may be expensive in the short term, and maybe we have the elections coming up, and we're going to have a bit of a shakeup. That's almost pretty much confident it's going to happen. Nobody knows when, where, and how much. So as long as you build a book and portfolio that is resilient to those drawdowns, you basically play again for the
Yeah.
upside.
Yeah. How many new public, you mentioned you're concentrated in 5 to 12 long names a year. How many new ones will you add in a given year?
So every year it's a function of the risk reward we have on a specific stock.
Yeah.
As a fund, we hope to make 25% net returns on a 3-year basis. So every year, every day, every quarter, we look at, is the portfolio reflecting making an incremental 20% on a go-forward basis?
Yep.
So the portfolio turn doesn't really turn that much. We keep the same stocks for a while. When we see something exceptional like a Unity or a Snowflake or an Ant Financial coming online, then we jump all over it. Right?
Yeah.
Because
Ant Financial is another great example of a company that most U.S. investors know nothing about, and it's a powerhouse.
And thanks to you guys, I'm invested personally through GGV.
Yeah,
so,
we know Ant. We know Ant well. Hey, let's maybe shifting gears for folks that are private companies, private CEOs, private founders. What lessons could you pass along to them? They may be a year away from going public. What do they have to do to build a really, they want to build the next Okta, the next Twilio, the next, aside from having great product market fit and growth and everything else, are there other tips that you would give folks that are maybe a year or two away from being a public company?
Yeah, it's a great question, Jeff. And in fact, I'm in discussion with probably 4 or 5 companies right now, advising them on this exact same topic.
Yep.
Some of them are closer, some of them are farther. The first thing is have a great narrative, right? Come up with a great framing of what your company does. If you are a marketplace company, don't give rule of 40 SaaS metrics. There's no need to do that. People look through it in an instant, right?
Yeah.
If you have great marketplace metrics, have great marketplace metrics. As simple as that. Everyone is trying to build this rule of 40 slide into their numbers, and it's completely unnecessary. Rocket Mortgage did that a few months ago, and I was like laughing, like who cares, right? It's a mortgage company. So one thing is first of all, by now, you should have a structure where every board meeting you are doing is being run like you were doing a public earnings call every quarter. You got to be on that cadence already, which means you've got to have a process to beat and, so guide and beat. Like it or not, you will be judged on a quarterly basis. Hopefully that's all noise, but to the extent you can guide and beat and you have a good handle on your business and it translates to financials, that's just really important. Number 2.
Yeah, to us, that's the single most important component is, have you figured out the predictable and sustainable part of your business? You can have a bunch of new things that don't factor in yet, but one of the big transition points for private companies is, in the early days, people put out, really aggressive plans, they don't hit them, and you're sort of trying to figure out what that sustainable growth engine is. Once you have that, then you can start thinking about being a public company. But what you don't want to do is go be a public company when your quarters are a mystery. You'll get crushed.
Your quarters are only a mystery, but more importantly, if you don't have a handle on your quarters, because then what happens is you will lose credibility in the public markets, and then getting it back is a total pain in the ass. So you don't want, right? So it's okay to be conservative and beat, like BigCommerce, love it because they were conservative and they will keep beating on a reasonably consistent basis in our estimates. But the point I want to make here is you got to have that financial and operational muscle that is working together in tandem. And you got to be very comfortable presenting to a bunch of investors you've never met before. That's number 2. Number 3 is just your narrative has to make a lot of sense. Number 4 is be transparent. Please be transparent. There's no need to, if you're a marketplace, show cohort numbers. If you are show your CAC analysis, show your contribution margin estimates, be conservative in your long-term margin structure by all means, but give data to help public market investors who are excited to own you for the long term, but give them something to work with. Don't treat them as if they are a bunch of fools who think they're short term, or because they're not, right?
Has that changed? Because I know people used to be very cagey with their metrics, particularly around SaaS businesses. Are you seeing people be more open today than they were 5 years ago?
I think SaaS companies have definitely learned their lesson and are much more transparent. Internet companies, again, we haven't seen too many internet IPOs, but there are a couple of companies in the past that have just not been very transparent. Right. And you get called out all the time. So if you've got good numbers, just be proud of it and show it. There's no harm. And if you have bad numbers, well, you don't want to go public. That's also an answer. Use this back for something else. Number 3, and last and most important, people don't realize this, hire a good IR person.
Yeah, I totally agree.
So important. An IR person will make a big difference to the CFO's life and frankly, the CEO's life, because he or she really can sell the company's story with credibility. Yep. And hopefully don't make them the spokesperson. Have them really understand the business and have a trust and have them be the gates into your organization.
Yeah, we've worked with some great ones over the years. Hey, we got 5 minutes left. Let's shift to kind of a little bit of a lightning round. So are there a couple trends or companies that you can talk about that you're excited about that maybe folks haven't? I mean, I know you're bullish on companies like Facebook and Alibaba, but maybe give us some things that people haven't spent as much time thinking about that you're bullish on, trends and companies that people could do their own homework on.
Yeah, I think that home exercise with Peloton and those kinds of companies are just a structural winner here. It's going to be great. It's basically SaaS in a box for the most part with a subscription model built in. You're buying the hardware. Peloton could well be the next Apple. Could well be the next Apple, in my opinion. Number one. So then we own a little bit of Peloton stock. We're doing the work on it. Number two, I think grocery delivery is here to stay. These are going to form incredibly huge companies that people don't fully understand yet. I think Instacart is going to be a structural winner in the US. It's going to be a food fight next year when everyone turns on some sort of grocery delivery. So we look towards a company like Rappi in Latin America, where they effectively have a blue sky opportunity to go build and scale grocery delivery. Those are the two things on the consumer side that I think are valuable. On the software side, we're huge fans of Unity. This is a classic story where people still don't fully get how big gaming is and is going to become.
Yeah.
With so many people, free to do whatever. And Unity's model basically works for a bunch of industries outside of just gaming, including architectural design and industrial design. So huge amounts of opportunity out there. And so we're actually very optimistic on Unity. And last but not least is a company you're on the board of, which is BigCommerce. People love to own Shopify, and I love Shopify as well, but the market's big enough for two incredible companies to be built in this space. So, B2B software that drives, commerce forward without the consumer is going to be a big trend.
Yeah. Well, I certainly agree. Hey, let me get another hot topic of late is SPACs. Do you have a point of view on SPACs?
I do actually. I've been skeptical on SPACs for a long time, but there's one SPAC I've invested in, which is Altimeter SPAC. It's going to do really well. I'm close to my old boss, and I'm thrilled that they have the SPAC out. At the end of it, it's very pragmatic. It's just one other option for a company to go public. You've got direct listings, you've got SPACs, you've got IPOs. Pick your poison. Every board member will now have to go as a fiduciary responsibility to look at all three options to take company public. And you do whatever is best for the company. And as long as you find a legitimate high-quality sponsor, like, for example, Altimeter, you'll be in great shape.
Brad's on right now, and he just said right answer.
Right answer, Brad, exactly.
Yeah, I think, that's been my answer to folks. It's like, hey, guys, IPO, direct listing, SPACs, to me, the idea that we get more, we have half as many public companies today as we had in the mid-90s. That's crazy. There were 8,000 public companies in the mid-90s. There's 4,000 now. So how do we get more companies public? I'm super bullish on the trend of, more companies going public earlier. The best performing companies historically have been companies that went public earlier. You look at companies like Five9 or, Five9 was a $300 million market cap company. Today it's $8 billion. So the chance to invest, to get public investors access to those kinds of companies, I think is super attractive. And then to your point, to have high quality folks like Brad or Mark Stott at Dragoneer or some of these other folks that are doing these SPACs, to me it's a pretty interesting opportunity for investors. The only thing I would say is, like anything, be selective, right? I don't think the 100%. Universe of SPACs are going to be successful, which the universe of public stocks aren't successful. So you got to pick.
I have a more critical view. I think most SPACs are going to be terrible.
Yeah.
I think, again, if you're a good company, find a high quality sponsor. And by all means, it's a great way to go public.
Yeah.
Just find the right sponsor. The problem is there are too many bad sponsors out there.
Yeah. What, I guess last question for you. I'm a newbie investor, and should I put my money in an index fund? Should I be on Robinhood? Do you have any advice for folks that are just starting out?
I think one, be in the stock market. It's the single individual wealth creator in the history of mankind, at least in America. I couldn't say that for all of emerging markets. I just think this is the Peter Lynch advice. If you're a newbie investor, observe, look, see what is happening in the world around you, and then put your money where your mouth is. Don't be seduced by a story that somebody comes on CNBC and pitches. Who cares about that? Look, observe. Jeff Bezos said, listen, it's easier to see what's not going to change in 10 years than predict the future. Peter Fenton at Benchmark had the saying, but said, listen, observe the present more clearly than predicting the future. I just think it's somewhat simple, and we complicate this business way too much.
Yeah. For those who don't know, Peter Lynch wrote a book called A Random Walk Down Wall Street. he wrote a bunch of books, but it's all about investing in things you believe in. So for example, I told my daughter to buy Shake Shack because she loves Shake Shack. And I said, you can't buy In-N-Out, which is your favorite. Your second favorite is Shake Shack, buy Shake Shack. So we're getting started early. But thanks it's been great, man. It's been great to catch up with you. And I'm so thrilled for all the success you're having at Octahedron. And obviously we're good friends, and appreciate you coming on.
No, super grateful, Jeff. Thank you again for the support, and shout out to you as well. Thank you.
Thanks, man. Take care.